Hello, my name is Ian Gordon, and today I'd like to show you a lifetime economic, financial, and investment map. I'm very proud of this because I've developed it by myself. It's been taken about 10 years of development to get to this conclusion, or to reach the conclusion here. But I think on this one page, I know it's very busy, but on this one page, you can see the entire Longwave cycle, all explained to you on this one page. And the other thing that this understanding of this cycle does is that it tells you how to invest your money throughout the Longwave cycle itself. So where should you be putting your money? And that Longwave cycle, as we've said many times before, is a lifetime cycle. So effectively, you only have to make an investment decision 4 times in your lifetime. And that investment decision is either you're going to invest in the general stock market and or real estate, or you're going to be invested in gold and gold stocks. You're never invested in the general stock market and gold stocks at the same time. So let's move into this cycle. So the first thing I want to do is to explain the 4 seasons of the Longwave cycle to you. So we're going to start over here with the spring. And the spring in our current cycle, and remember this is the 4th of these Longwave cycles, so in the current or 4th cycle began in 1949. And how do we know that spring was beginning? Well, there was an interest rate bottom, and debt levels reached their cycle low at that time, and you had a stock bear market bottom on June the 13th, 1949, when the Dow dropped to 161 points. So those 3 factors indicated to us that we were going to go into the spring of the 4th, or our current cycle. And what is spring? Spring is the rebirth of the economy. So what happens in spring? Well, you get a gradual increase in business activity and employment. You get consumer confidence slowly increases in line with the growing economy. Remember, when spring starts in 1949, the confidence level is at an extreme low. Most people think that we're going back into a depression. However, most debt has been wrung out of the economy, and there's a lot of consumer savings, so that the economy starts to build based on those savings. Consumer prices begin a gradual increase from very low level, and stock prices begin a steady rise and reach a peak at the end of spring. The stock prices are rising in unison with the growing economy that occurs in the spring. And then interest rates rise slowly from historically low levels in line with the gradual credit expansion. Credit is only just starting to be moved into the economy during the spring. Most banks are nervous about lending, and most consumers are nervous about borrowing, because they've all gone through the depression stage of the cycle when debt has been wrung out of the system, and lenders and borrowers have been both hurt during that process. So how do we know when spring comes to an end? And our spring ended in 1966. The indication of the season change is that big stock bull market peak, which occurred on February the 9th, 1966, when the Dow hit 995 points. So that peak tells us we're going into the summer. And the summer of the cycle is always the inflationary period of the cycle, because there's always been a summer war. And the first cycle, that war, was the War of 1812. And the second cycle, it was the US Civil War. The third cycle was World War I. And the 4th cycle was the Vietnam War. And that war has always been financed by a massive increase in the money supply. And that increase in the money supply leads to a major inflation. And inflation always peaks at the end of summer. And gold prices reach a significant peak at the end of summer. as do commodity prices, and interest rates rise rapidly also to peak at the end of summer. And the stock market is under pressure and ends summer with a bear market low. So how do we know when we've reached the end of summer, which in this cycle occurred between 1980 and 82? There's the economic recession, the 81-82 recession, similar to the 2021 recession. There's a peak in interest rates, a stock bear market bottom, which occurred on August the 12th, 1982, when the Dow dropped from just over 1,000 points to 777 points, and a peak in consumer prices. So we're now going into the autumn of the cycle. Autumn is always the biggest bull market in stocks, bonds, and real estate of the cycle. So what is autumn? How do we understand autumn? Money is very plentiful. Inflation, which peaked at the end of summer, starts to fall into disinflation or falling inflation. Gold bullion and gold equities are in a bear market and reach a bear market low at autumn's end. And then you have a massive stock bull market, and speculation is rampant during this period. You have financial fraud is prevalent. Real estate prices rise to enormous level driven by huge speculation and peak at autumn's end. And debt reaches astronomical levels by the end of autumn. And consumer confidence is at all-time high due to stock prices, real estate prices, and plentiful jobs. So how do we know when when autumn is ending and we're going into the winter? The indication of the season change is the major stock bull market peak, which occurred for the Dow Jones Industrials on January the 15th, 2000, when the Dow hit 11,750 points. We also at that time reached a peak in consumer confidence. And at the same time, the gold price bear market bottom, which occurred in July 1999, when gold bottomed at $252 an ounce. So now we know we're going into the winter of the cycle. And what is the winter? What is the sort of the things that we see in winter? It's not a good time to be in the cycle, and unfortunately that's the period that we're living in right now. There's a crippling credit crisis. Money becomes very scarce. Banks don't want to lend. Consumers and corporations don't want to borrow. Banks, trusts and quasi-banks and insurance companies are all in crisis. We have unprecedented bankruptcies, both personal, corporate, and government. We have a credit crunch where credit is not available, and during that credit crunch, interest rates rise. So interestingly, what you're seeing is in places like Italy and Greece, there you have a massive credit crunch, so interest rates are rising right at this period in time. They're going to have the same factor is going to occur in the United States as well. We're going to see interest rates rising as the credit crunch really starts to take hold. And you have an international monetary crisis similar to the crisis that occurred between 1931 and 1933, when the entire world monetary system collapsed. And again, we're seeing that collapse beginning initially here in Europe, or initially in Europe, and thereafter it's going to spread throughout the world. And gold bullion and gold equities rise in the face of huge financial and economic crisis. And you'll have a pension crisis. Pensioners will not receive what they've been promised.